with the exchanges then? Because I mean, Binance, all of them. I mean, they've made it so difficult. It's simple when you want to buy something, but to sell it, they're actually they're making it painful for people. And like, one is obviously protecting your wallet and taking it off the exchange. I mean, I know if you're trading and everything like that, but can you see people simplifying that and getting that should know your customer? I mean, there's a lot of regulation and everything, and people seem to want regulation when they're getting scammed and everything. They want to be protected, but when they want to do all the transfers, they don't want nobody knowing because they want to keep it in their own pocket. So it's a catch 22 situation.
Part of it is, this is a twofold question. One about KYC, one about exchanges. The biggest issue right now, and I see this especially now that like PayPal and Venmo and Robinhood are getting into the selling of crypto. One of the things that individuals, the retail investor that buys this doesn't realize, you don't own that. You don't have a wallet assigned to you. It's bought into a general ledger. Robinhood owns that. So if you wanted to sell it, unless there's somebody that wants to buy it, it's not like, public equities and public securities that there's market makers, there's people that are buying it without you needing to have a buyer that'll then liquidate it on the other end. No, it's like, it really is very clear. If there's no one else to buy this, because this is like blockchain 101. If there's no one to connect to the next block, you're not going to have a liquidity event. And what you see is things like, these meme coins that are going out, increasing in value. And then when things are going south, no one has any liquidity because nobody wants to buy them. So therefore you can't get rid of it. And that's, I think, the inherent risk is, one, you don't own it. Two, there's not enough liquidity on the other end because there's not enough, unlike public equities, market makers, custodians that'll buy it. So it really creates this very one-sided like experience. And that's sort of where a lot of the education isn't for those that are buying cryptocurrencies, because there's always going to be someone that wants to buy the big ones. But traditional like meme coins or meme tokens or stable coins, like there has to be a liquidity event on the other side. And it's hard because, there has been so much failure in exchanges recently that I think the need was to regulate them, but coming into the next 4 years, we're not going to have regulation. We're going to have a deregulation that's going to happen to the banks and to tokenization. And part of that regulation is we still have not yet defined, where do these exchanges live? Are they on the public equity side? Are they financial assets? Are they MSBs that are using it to run, like, if you look at, the banks are highly regulated. And so in order to open up a bank account, you have to go through bank KYC, the Know Your Customer, AML. Well, if you're doing remittances are less regulated than the banks because people are just trying. And so there really hasn't been this idea of, where do these use cases live? Because they're still outside. They're outside the US regulated industry. And so that people remember, like 15 years ago, 10 to 15 years ago, gains and losses were not reported by the IRS. Only just recently is the IRS saying, hey, did you make any money from digital assets? That's fairly new.